In Signal episode 11, we explored how structure, patience, and precision creates the rhythm of professional investing, where every portfolio is built with intent and clarity. In Signal episode 12, we move from composition to circulation, from rhythm to rotation, understanding how money flows across different sectors, sustaining growth even when market looks stretched. Welcome back to Signal, where noisy markets meet simple, sharp and sound insights for long-term investors. The Sensex closed the week around 84,211 points, while Nifty settled around 25,795 points, both easing slightly after seeing new highs on Thursday. Markets were influenced by global earnings cues and evolving expectations around US interest rates, while domestic optimism in manufacturing and infrastructure helped maintain steady momentum. Capital goods and defense showed strength earlier in the week, while IT and FMCG witnessed consolidation towards the end of the week. Foreign institutional investors were net sellers, whereas domestic institutional investors and mutual fund SIPs continued to lend consistent support to market stability. Overall, a week that began with optimism, tested conviction midweek, and closed with quiet resilience. And that sets the stage for today's theme: money in motion, as we explore how capital rotation becomes a quiet engine of sustained market growth. As markets touch new highs, investors are once again faced with familiar question: is it time to buy more or step back? The truth is that markets don't follow a linear path. They evolve through phases. Leadership changes, sentiment shifts, and capital keeps flowing from one opportunity to another. Money doesn't multiply by magic. It multiplies through movement, from banks to capital goods, from IT to FMCG, from large caps to mid caps. That's the rhythm of a healthy market. The baton keeps moving, and with every turn, a new leader emerges. For instance, in previous cycle, banking and power led the way. But now the momentum is shifting to capital goods, defense and manufacturing, driven by rising government and private capex or capital expenditure. For investors, rotation is a reminder that capital always finds its purpose. When a sector becomes overcrowded, another one quietly makes room for opportunity. The art lies in staying observant and spotting the shift early. For example, when banking and power led the rally last year, many investors gradually booked the profits and reallocated to emerging sectors like capital goods and manufacturing, positioning themselves early for this year's upswing. So, what can investors do today? Look within your portfolio, study and identify what has worked and why. Sectors that have already rallied would look expensive, whereas future growth drivers would begin to show the momentum. Consider rebalancing into areas like manufacturing, infrastructure, consumption, capital goods, areas that are aligned with India's next phase of growth. Rotation is about recognizing where value is quietly shifting and staying prepared to participate. And here is where a SEBI registered investment advisor becomes invaluable. They have the insight, foresight, and clarity to help you navigate rotation with purpose and position your portfolio for the next phase of growth. Who understands rotation better than a farmer? For our story of the week, let's walk through a farmer's field to understand why rotation is quintessential for sustained growth. At the beginning of each season, farmer Kanu stands at the edge of his land, watching the soil, feeling the wind, and deciding what to plant. He never grows the same crop on the same patch every year because he knows what once gave abundance, if overused, may soon lose its strength. So he rotates his crops. Wheat follows rice, lentils follow maize. Each crop restores what the other consumed, balancing the land, sustaining the yield. Markets work in the same way. When one sector has given its harvest, Another field begins to show promise. Capital, like the farmer's seed, must keep rotating to keep the system fertile. Because even the most fertile field turns barren when planted with the same seed for too long. And just like farmers' field, markets too thrive on cycles of growth, rest, and renewal. Which brings us to our quote of the week. The stock market is the story of cycles and of the human behavior that is responsible for overreactions in both directions. Cycles are what keeps markets alive, a natural rhythm where leadership changes, sentiment adjusts, and capital finds its next purpose. Capital, just like nature, rewards rotation, not repetition. Markets thrive when capital keeps flowing across ideas, industries, and innovation. Rotation is how markets renew themselves. The quiet process through which yesterday's leaders make room for tomorrow's builders. As markets reach new highs, the real question isn't whether it's a hype. It is where the next opportunity is quietly gathering momentum. For investors, the task is to be aware of that flow. Recognize when cycles shift and when new ground is ready for growth. Money in motion keeps markets alive, but discipline in motion keeps your portfolio thriving. Rotation is about understanding where value migrates with the readiness to position and participate. We are building a strong community of robust, reflective, and resilient long-term investors. If you're one of them, why not like and subscribe us and tell us in comments which sector you think will lead in next market rotation.